York City, New York asks, I would like to hear your opinion in regards to how quickly gold and other commodity prices will react negatively to rising interest rates when the crisis you were talking about does happen.
Commodity prices will already be a lot higher because inflation would have already pushed them there. And I think that when the Fed does start to raise rates, it'll be too little too late to slow that down. I think the only interest rate raising scenario that would be bearish for commodities would be a very aggressive Fed that moved decisively and rapidly and was very aggressive in its rate hikes. And right now, there's nothing that I've seen that would indicate that that's going to be the case. In fact, Ben Bernanke, in his most recent press conference, stated that when the Fed finally decides that it's time to raise rates, it's going to do so very slowly. So I don't think rising interest rates are going to do anything to dampen a commodity rise. In fact, ultimately, I think it will be higher inflation that is what causes the Fed to move on rates, and that is going to be, evidenced by increases in commodity prices. And I think that will continue even after the Fed begins to raise rates, because I believe it will raise rates much too slowly to actually make a difference. And that what's really important when it comes to things like commodities is going to be the real rate of interest, not the nominal rate. And it's quite possible that even as the Fed is raising nominal rates, real rates are falling because inflation is accelerating faster than the Fed's rate hikes. And so that means that the commodities in general, to the extent that they're going up as an inflation hedge or as a consequence of inflation, that's not going to slow down. That's just going to accelerate.
Joseph in Lake Forest, California asks, regarding taxation, what would happen if the earned income credit were to be eliminated? How much would be constrained to the Treasury rather than distributed to qualified recipients?
Well, I don't know the exact amount of tax revenues that are foregone based on the utilization of that credit. But I do think that the entire income tax should be scrapped, not simply trying to change the way we're taxed. The earned income tax credit, whether or not that should be included in the income tax that we have today is a different debate. I'm not really sure how much revenue is lost, or how many people are encouraged to work as a result of an earned income credit, or discouraged from working because they're earning a level of income beyond which they would start to lose that credit. So I know that the existence of that credit does impact behavior, which I think is an unfortunate byproduct of the tax law. And what you want to do when you're raising money for government to fund the legitimate purposes of government, as few and limited as those legitimate purposes are, you want to raise revenue in a way that generates the least impact on the behavior, on decisions. You want decisions to be based on market forces, not political forces. And so, for that reason, we should be raising revenues from sales taxes or other consumption related taxes that don't do much to alter behavior.
Joey in Danville, California asks, I am thinking of starting up a solar company and was wondering if this is now a good industry to be in or a bad one.
I don't know. I mean, depending on what kind of products your company is offering, a lot of solar companies survive simply because of special favors from the tax code or loan guarantees from the government. I have no idea what your solar company has to offer, if the products are legitimate, if they can stand on their own, or if they require the existence of a tax credit or a subsidy to make them viable. I know that energy costs are going to be rising, fossil fuels, and so as the cost of energy goes up, people will be seeking out alternatives. To the extent that your particular solar alternative is viable and economical, then it might be a good time for your business. But not knowing anything about your particular product or how effective it may be, I really am not in a position to offer you much advice.
Kingto in Houston, Texas asks, I was watching one of your debates on YouTube, and you mentioned that with respect to our national debt, if interest rates rise, then our interest payments alone would rise also. But isn't our current debt already pegged to a very low interest rate via our previous issues of bonds? Are those rates not fixed?
That's been my point, is that we're not doing that. Had the U.S. government issued the majority of its debts in 30-year bonds, then these low rates would be locked in for 30 years. But that's not what the government did. The majority of the money that's being borrowed is being borrowed in much shorter instruments that mature in 90 days, in 6 months, in 1 year. So while you do have a small portion of the debt that's financed with long-term debt, you have the majority of it financed with shorter maturities. And so what happens is, as those shorter maturities mature, the government now has to reissue them, or the government has to borrow new money to retire the maturing debt. Because, of course, we can't pay it off. We don't have the money to pay it back. So whenever bonds mature, the government has to refinance, and it depends on what the current rate of interest is. So when interest rates ultimately rise, let's say interest rates are 10%, and a note matures that was paying 2%, the government had a 2% coupon, and now it matures, and now it needs to roll it over at 10%, that is a dramatic increase in the financing costs. And that's my prime concern when it comes to the financing of the debt, is the vulnerability to a rise in interest rates that the taxpayer is exposed to. It is very similar to mortgages, where people took out a teaser rate and it reset. And when rates went up, whether it was because rates actually went up or because the teaser period expired and your mortgage reset to a realistic rate rather than an artificially low rate that you might have enjoyed during that teaser period, a lot of people were ill prepared for the increase in payments. Many people thought it didn't matter because they would extract additional equity or sell their house or refinance again and get another sweetheart teaser deal. But the reason that borrowers did that is because they wanted the benefit of a lower payment in the short run, and they in exchange for the risks associated with a sticker shock when the payments went up. Well, that's what the American taxpayers are subjected to. Politicians, in order to minimize the current cost of servicing the debt, have made a bad gamble. They've traded some short-term benefit for some real long-term liabilities, because ultimately rates are not going to be at record levels. Why isn't the U.S. government taking advantage of these record low rates to lock them in for 10, 20, or 30 years? Because if they did that, rates would move up at the long end, and the government would actually have to pay more money today to finance the debt. They don't want to do that. They're trying to minimize that cost, even if it exposes taxpayers to much greater costs in the future when interest rates rise, because politicians don't care about the future. They care about the here and now. The future is somebody else's problem, because they may not be in office in the future. So what do they care? Their job is to get reelected, not to worry about the consequences of what they do to get reelected.
Ignacio in Uruguay asks, "Hi, Peter. I would like to know if a diminution of the supply of goods and services with a stable monetary base has the same effect as inflation."
Well, it would have the same effect on prices, right? If you reduce the supply of goods and the supply of money is going to remain the same, then the price of those goods is going to rise. So that's going to be the same. And if you think about inflation as an expansion in the supply of money relative to the supply of goods, then that will hold. Although I don't look at it that way. I just look at inflation as the expansion in the supply of money, and I'll throw credit in there as inflation. What happens to the supply of goods is a total separate phenomenon. And if you want to know what happens to prices of goods, you have to look at both the supply of money and the supply of goods. Because let's say that the supply of goods is increasing by 2%. That doesn't mean the government should create 2% inflation to hold goods prices stable. And just because goods prices are stable doesn't mean there's no inflation. Because what the inflation does is it masks the 2% decline in prices that otherwise would have resulted had there not been inflation of the money supply. And I think that robs citizens of the benefit. If the supply of goods is growing faster than the supply of money because of the increased productivity that enables that production, then we should benefit. Prices should be allowed to fall so that people can benefit from lower prices because they now have more purchasing power. They can now buy things that they couldn't afford because those things became less expensive because of the productivity involved in producing them. So it's still inflation. But if you're simply looking at prices, the price of goods is a function of the supply of those goods and then the money that people have to bid for those goods. The more money there is, then the higher the price is going to be, or vice versa.